And so, Ty, good morning. I can see you there. Are you in Dallas this morning?
Good morning, Hugh. I am. I luckily got back into Dallas from Vegas yesterday in a snowstorm. So,
I'm glad you made it back. I want to do our disclosures. I am an investor. Your counsel says I've got to warn people that I'm an investor, even though my fund is closed, but I'm an investor in Key City Capital. Number two, you're a sponsor of this show. Number three, this is not an offer to sell securities. It's just telling people what they want to know, which is, why do I like Key City Capital and why did I invest a chunk and change? And I would show them, I got in my email yesterday, we didn't even know this, Ty, when we set up this date. I got my monthly end of the year, December 2022 investor statement, and the fund in which I am invested, which is closed now, it's Fund 3, they're having a great year. Are all of your funds having a great year?
They are. We're making good distributions. We're watching the market still stay strong in the rent space, what we stay in. And, you know, what we always say, B and C class properties have a hedge against the market that some of the others don't, because when the market is strong, you see a good tenant class that tends to move up. You see your workforce housing take over a strong space where you've got your mechanics, your operators that are working in the real estate space. And then when the market goes down, you see more nurses and more lower tier white collar workers living in your space. You see a little bit of turnover, but you don't see the vacancy that some of the A-class properties do.
No, I want people to understand the new fund that is opened is fund number 11. And I got the prospectus for fund number 11. I'm not invested in fund number 11. I'm not going to invest in fund number 11. I'm in fund number 3, which is closed. But for the first time, I saw an offering that actually lists the pictures of the properties that are going into fund number 11. For example, the last asset to be purchased for KCAP Real Estate Fund 11 will be Villa Gardens, located in the Dallas-Fort Worth Metroplex. The acquisition consists of 142 units for a total purchase price of $24,832,000. This will complete Fund 11 with a total of 1,375 units and 6 unique apartment complexes across the state of Texas. This is a Texas-only fund, Ty. Did you set out to do a Texas-only fund?
We didn't, and we got a couple of good opportunities in College Station, great college town, Texas A&M. Those did well. And then all of a sudden, we started seeing the interest rate hikes. And what we saw was a number of operators that did not have the capital capacity that we do, and they weren't able to meet their debt offerings. They weren't able to meet the capital needs that they needed to increase the values in the property. And so they're kind of stuck in a marketplace that they weren't able to operate in. And so we're able to do debt assumptions. You were talking about the Fed increasing rates, and we're seeing that. We're assuming current debt at about 3.2%. And that made Dallas a huge opportunity for us where it hadn't been in the past.
That's what I was going to get to. Remember, this is only for qualified investors. This is a 6-figure investment. It can be 7, it can be 8 figures if you want. I don't know how much money is left in Fund 11, but you're just going to move on to Fund 12, aren't you, Ty?
We are. We're actually, we already have our next property lined up for Fund 12 as well. It's also a Dallas property. Same situation. Our last 3 purchases and the 4th one coming up are going to be those debt assumptions. And unfortunately, we saw a number of operators get into markets like Dallas and some of the major 5 markets that just didn't have the capital capacity to make it through a dip in the marketplace like we're seeing. And so that's an opportunity that we at Key City Capital are definitely taking advantage of.
If people want information on Key City Capital, again, they are a sponsor of the show, and I'm an investor in Key City Capital. Go to keycitycapital.com/Hugh, and they will send you information, but you got to be a qualified investor. Increments of $100,000. Now, Ty, when interest rates go up and you've assumed debt at 3.5%, does that not give you an incredible advantage over every other competitor?
Oh, it gives us a huge advantage. And those assumptions were Fannie, Freddie, and HUD assumptions. So in doing that, that got us on national debt space, which we're now a preferred borrower of Fannie, Freddie. So we get the best debt, we get the best opportunities, but that's because we had the capital to do so. There's a very limited number of operators that have the ability to get that kind of debt. And we finally reached that pinnacle to where we're amongst the elite operators in the United States And so we get access to elite capital. And that is a huge opportunity for us and our investors, because now our investors are going to get to see a little bit less risk than what most other operators are having in this market space when you're looking at 6 and 7% debt.
Now, what I want the audience to understand is that once a month, Fetching Mrs. Hewitt and I get a check from Key City Capital. And our balance remains the same. The original investment, and it's running about 8% this year. So I thought it would be at 4%, but it's running about 8% this year, and on an annualized basis. We just invested in August. So I don't know if there'll be bad months. There's no past performances, no promise of future results. But generally speaking, of the 10 funds that you have opened and closed, what's the return on investors, Ty?
I mean, we're running in the double-digit average, and that's because when we do start selling the properties, there's appreciation as well that is captured by the investors. But the cash flow on average is running 6 to 8%. We expected a dip especially in Florida because of the hurricane. We did have a small dip in one of the funds. It's not a fund that you're in. While we renovated properties that were affected by the hurricane, insurance covers some of those losses in cash flow. We haven't brought that in yet, but we will be doing so. But then we saw it pick back up. And so we distribute every cash that's available based on the rents that come in. And that typically runs right around 8% is what we're seeing. And I expect it to continue to do so. But, 4% to 10% is not unlikely in these funds.
Now, again, for the benefit of people who are just tuning in, have never heard me before, I got new affiliates starting on April 1st. You are a sponsor of the show, but you do not pay me to say this. I'm a very happy camper. I'm a very happy camper because I don't want sexy. I don't want Bitcoin. I don't want Coinbase. I want real estate. I want apartment complexes, and I don't want to own them because that was my first job as a maintenance worker in an apartment complex, and it's a pain in the neck to run an apartment complex. So would you just tell people, when did you decide I will take on the pain in the neck that is an apartment complex?
14 years ago, for some reason, I started flipping properties. We've talked about this before. I knew that the goal was to get to holding cash flowing properties. And anything that I do, I always say anything worth doing is worth overdoing. And so when I got started in doing it, I built systems and processes that help us manage those pains in the neck. Now, it took a good 10 years and kicking in the nose to get to where it was boring. And I say success is boring. And when you can create something that's boring, then you know that you've accomplished it. So.
Ty, I've never heard you say that before. That is absolutely true. If it's boring, if you know it's going to come up, if a problem arises and you've seen it before, it's sort of like this radio show we've been on for 23 years, and we've seen everything happen or not happen, and nothing surprises us. So I assume you've dealt with fire and hurricane, earthquake. I assume you've dealt with drought and snow and electrical outages. I assume you've dealt with bad tenants and good tenants and police incidents and non-police incidents. So generally speaking, is this the best area for people who want safety in their investment going forward?
Well, I can say that every one of those that you just listed, we've experienced with the exception of earthquake, knock on wood, and we're still kicking strong and we're still going strong. And we just had a dinner event the night before last, had about 60 investors there. All of them were extremely happy. I mean, there's good news, there's bad news. Bad news is we make mistakes sometimes. Those mistakes came in the form of accounting. Accounting was slow to get things out. We notify investors as soon as there's issues with those. We tell them the exact way that we're going to fix it, and here's what it's going to look like, and here's how long it's going to take to fix that. And we also have good news, and the good news is we're going through a tough market like this, and you're still seeing cash flow and distributions that is outperforming most of the operating space right now in the multifamily class.
Were any of those 60 people Hugh Hewitt listeners?
They were. We had 4 or 5 of them that were Hugh Hewitt listeners. So, yes.
That makes me happy because I actually am happy when my audience does well. KeyCityCapital.com/Hugh. Ty Lasater, have a great Wednesday. Thank you for taking time early in Dallas to fill people in on how fixed income returns from real estate makes sense. KeyCityCapital.com/Hugh.